Hi, good afternoon. Welcome to the marketplace. Coming up, government likely to commence Eurobond debt repayment this year, but that of bilateral creditors will start from 2026. Also coming up, Ghana earns $1.2 billion as savings from monies gotten from crude oil exports since commercial production. Plus, MPs to begin debate on mid-year budget presented by the Finance Minister. Will check in with parliamentary correspondent Kweku Asante. My name is Darrell Kwao. Thanks for being with us. Details coming up. And thanks for staying with us, everyone. Government is expected to commence servicing Eurobond debts before the end of this year. However, that of bilateral creditors should start from 2026. This is what Joy Business has picked up from persons negotiating repayment of these debts. George Jaffe has details.
Under the agreement reached with the Eurobond holders over terms for servicing their debts, government is supposed to start paying them as soon as an agreement is signed with these bondholders. Joy Business understands that government is looking at presenting that final agreement to these creditors for them to sign before September this year, and then after that, it will start making the necessary payments. Sources say government is currently finalizing documentations on these debt payments and the agreement and will forward to them very soon. The country could be saving about $2.8 billion when it comes to servicing the bilateral debts and more than $9 billion for the Eurobond. Now, these are monies that government would have paid if it had not restructured these debts. But the IMF, in a new document, is warning of some challenging times for the economy if government is not able to sign an agreement with these bondholders and start the repayments of these debts before December this year.
Economist and research lead at GCB Capital, Courage Buti, joins me on Zoom to discuss this. Good afternoon to you, Courage. So, first off, educators, what do these negotiations entail?
Well, good afternoon to you and your listeners. So, I think the conversations have started way back. It's been about agreeing terms on what haircut to take within the framework of the debt sustainability analysis done by the IMF and the World Bank some time back. And so the clear parameters to restoring debt sustainability have been defined, and they were really working to achieve that. So I believe part of the negotiation will mean what interest rate to pay from now going forward, what principal haircuts to take from now. That will mean that by the 2028 timeline, Ghana can achieve debt sustainability. And the official creditors were not going to take haircut, partly because they are already lending at a concessional rate and all that. So they may just consider reducing interest rates and granting some moratorium. On the commercial side, where interest rates are much higher, they could accept some haircut. They could accept some interest haircut as well. And that is exactly what has been achieved so far, pending the official sign-off and consent solicitation, really. So I think where we are in the process now, after the OCC has given approval that the agreement so reached met the comparability of treatment clause under the common framework, will be for government to launch consent solicitation, where all the other investors will tender or put in their consent that they are willing to tender the bonds. Thereafter, government will issue new bonds to replace the old ones based on the terms that is agreed under the agreement they have so far. So I think that is where they are in the process. Legalities will come in here, drafting the agreement based on the terms agreed and all that will have to come in, and then ultimately they launch the consent solicitation based on the memorandum they will put out.
Right, and so government is looking at the target of end of year to start repayments. How likely is that based on the processes they have to go through to ensure that takes place?
Oh yes, I think the initial notice was that they are seeking to go into the phase of consent solicitation this month. The month is almost ended, so it doesn't look like it for me. I'm not aware of clear timelines at this point. I heard George mention September. It looks like it's in the works, but the indication is that once the debts are restructured, then you would have to resume, and the coupon payment is semi-annual. So 6 months after restructuring, you would have to. So if the new bonds were launched, probably in this month, then you could expect that towards the end of year or early next year, we may have to be paying some 400 or so million as the first coupon payment. And there are also other terms in there that will even require some down payment on the bonds and all that. But depending on the timelines, so the timelines that we will complete the exchange will determine when the first coupon will be paid on these bonds. But the moment you restructure them, they become active bonds. Then the interest suspension that was announced December 2022 will no longer take effect. And then you would have to resume normal coupon payment on these bonds going forward.
Yeah, so the IMF, based on our reporting, is warning of risks to the economy if we are not able to sign off and start the repayments by the end of the year. What are the risks?
Well, I haven't cited that IMF report, but on top of my head, there is a framework. And the debt standstill wasn't equivalent to forgiveness. So I want to think that whatever interest you would have had to pay from when the debt standstill was announced till now would have been built into the model we have now, and what haircuts and what principles are outstanding. The longer this drags, and you need to complete the debt restructuring to even restore that sense of debt sustainability, and a number of disbursements that are tied to those are due this economy are tied to the completion of those debt restructuring anyways. And then even you regaining access to the market eventually are all tied to when you complete this. When you complete also, you open up your markets to offshore investors who may even begin to look at the local currency bonds which have been restructured like some time back and all that. So the longer it drags, the more the sentiments are bearish, and probably the more you lock up the flows that are tied to you completing debt restructuring, really. And then you also prolong the time to regaining debt sustainability. I think those may be the key concerns, but I'm yet to cite what the IMF put out and the details of it.
Yeah, and final question, how significant are the savings you are making from servicing these debts? We're talking about $2.8 billion from the bilateral creditors, more than $9 billion from the Eurobond holders.
So in terms of savings, if it's a haircut, we're talking just about 4.7 billion on the Eurobond side. That will mean that your principal amount, however it's determined, will be about 47% of it will be written off at the time of exchange. Now that's significant. That means your debt stock is reduced by that much. In terms of the cash flow reliefs, they are not necessarily savings, as in money that will hit your account. They are actually just deferred payment. So, for instance, if you were supposed to be making some coupon payment or some amortization now, it's been deferred to maybe 3-4 years now. It's equivalent to you owing me. And then I say that because you need money now, keep the money and pay me maybe a year hence. You will still pay. You will still have to build buffers to do it. And what it does is it gives you time to build enough buffers to pay, but it's an obligation you will pay nonetheless. So the narrative about savings need to be put in context. In terms of savings, what we could actually call saving is a 4.7 forgiveness, principal haircut. But in terms of the interest and the deferred payments, they are actually moratorium granted to us to give us the leg room to mobilize and accumulate enough to start paying and deal with the immediate cash flow shortfalls. And so I wouldn't necessarily call them savings. They are cash flow reliefs in the meantime.
All right. Always insightful to speak with you, Courage Boti, research lead, GCB Capital, also an economist. I appreciate your time with us this afternoon on the marketplace. Let's turn to other news. Ghana has received $1.2 billion as savings from monies earned from crude oil exports since it started exporting the commodity in commercial quantities. There is more in the following report.
Ghana's oil accounts at the Federal Bank of New York, USA showed that since the country started commercial exports of crude oil, the Heritage Fund, which allows requires government to save some of the monies earned from crude oil exports for future generations, had about $1.1 billion ending June this year. However, the Stabilization Fund had $194 million. The account showed that there has been some withdrawals totaling $90 million. The fund is supposed to support government's revenue in case earnings from crude oil drops so that the budget is not affected in terms of supporting some projects in the country. The accounts also showed that just about $130 million were saved in these two funds just for this year. However, when it comes to the first 6 months of this year, about $840 million have come in the form of taxes and royalties that has been paid to government by the various companies working on the country's oil field.
So, with a surging demand for lithium, cobalt, and other critical minerals required for renewable energy technologies, the world is looking to Africa's vast extractive resources. The continent's critical role in supplying the minerals powering the global transition to clean energy took center stage when government officials, industry titans, investors, and other influential figures convened in Washington, D.C. in the U.S. for the Africa Investment Risk and Compliance Summit earlier this week. The summit explored resource extraction in a changing climate, compliance strategies, and innovations. We want to explore this a bit with Adwoa J. who is President and Chief Executive of the EBI Group, organizers of the summit. Good afternoon to you, Adwoa. So, Africa plays host to the largest deposits of critical minerals in the world, worth over $406 billion. What kind of partnership and investment should the continent be looking at currently?
So that's a good question. Africa needs investment that will propel the continent really to be in a position to expand production outputs of its natural resources. And that will mean that the next sort of Africa investment will drive into its critical minerals should focus on adding more value. So investment that add value, that create more sustainable jobs for the people of the continent, and more economic value for our minerals. The second thing will be that Africa needs investment that can really transfer technical know-how to the continent. That is really more responsible and more sustainable. So a lot more African sort of oil rigs and mineral firms are in total control of foreign investors, mainly because we don't have the money to invest. And then second, we don't have the technical capacity for that investment. So really, an investment that allows a transfer of technical know-how is very key. And so those are my two sort of reasons.
Right. And what are the key metrics global investors are looking at before deciding to invest in the exploration of these critical minerals?
There are several metrics. One of the first one is really the political stability. I mean, we've seen what's going on in Kenya, and we saw how the president of Kenya was in the United States just about a month and a bit ago, and major of these corporations had promised to come partner with Kenya to come and invest. And now you're seeing how many of them are also pulling out at the moment. So political stability is very key. An investor wants to come to the country and know that everything remains stable, even when there's a change of government. A new government won't completely disrupt how things are done. Also, the financial sort of risk compliance and transparency, it's a key one. Foreign investors are, they are shying away from countries that are corrupt. And I'm not saying Africans are more corrupt than anyone else or are corrupt, but any country that seems to be on the radar for corruption, they will shy away from those countries. They want to operate in countries that are safer. They have strict sort of controls, regulations, and not just the regulations, but also those rules and regulations are implemented and they are policed properly, they are enforced. And, the people of those countries also understand their responsibilities, especially if they want to attract investors. So there are several metrics. One of the first one is really the political stability. I mean, we've seen what's going on in Kenya, and we saw how the president of Kenya was in the United States just about a month and a bit ago, and major of these corporations had promised to come partner with Kenya to come and invest. And now you're seeing how many of them are also putting it.
Oh, and what are the ethical and responsible approaches to attract these foreign investors?
I mean, we see the big agenda of the ESG, the environmental, social, and governance. Really, that would be more the social standpoint. How is what what is happening on the continent affecting the local communities? And so it really starts with the government. The government have to communicate very clearly what they stand for, what the expectations are, so that when an investor is coming into the country or the continent, they have a clear understanding. Because I always say that, when you go to a place where the rules and regulations don't work, most people will take advantage of it, whether it's an investor or even people from within those countries. So I think it's important that that's very clear. And, you go to certain countries, and in Nigeria and in some parts of the world on the continent, if you're an investor, you're coming into the country, you have to ensure that some part of the business is owned by locals. And there are also certain guidelines, especially with the extractive industry, where many of these companies come and extract the minerals, and of course they leave the local communities in poverty, in lack, and in struggling. So these are something that I would say that the countries, the government of these nations should be very clear exactly what the expectations are, and that should be communicated clearly, and that there should be structures in place to make sure that investors understand that, and they are working with the local community and the government to make sure that there's mutual beneficial outcomes.
Right. Does Africa stand to gain from this shift to clean technologies, and how is this summit, or how has that summit shaped the conversation?
They should be interested in this conversation because we see in most times investors, especially within the US, Europe, they are very keen at the moment. There's a lot of excitement about Africa, but they are also very skeptical. The communication out there is that Africa is corrupt and Africa is high risk. And how do we ensure that there's a clear understanding of, to these investors, they have a clear information on exactly what the risk, true picture of the risk on the continent is, what is their perception, what is the true picture of the risk. So Africa can only benefit from the critical minerals when we change the way we explore these minerals. And we can do that especially through how we sign, the kind of contract we're signing, the resources that are shipped out of the continent and in their raw form. So there's more of a shift towards how do we partner with foreign investors to ensure that a lot of these resources on the continent are not shipped out in their raw form. They are turned into finished products and then exported so that more of the returns can remain on the continent.
All right. Thank you so much, Adjoa J. Chum, president of the EBII Group, joining us for the conversation on our extractive industries. This is The Marketplace. Up next, business and politics. All right, let's check in with parliamentary correspondent Kweku Asante, because we expect MPs to begin debating the mid-year budget after the presentation was made by the finance minister Tuesday. Good afternoon to you, Kweku. So when is the debate set to begin?
Well, we expected that the debate would have commenced this morning, but there has been some delays because the majority leadership have asked the House to consider some bills first. And so at 10 o'clock, when the House started sitting, quite later than that, almost today, the House decided that we're going to consider bills. First, the affirmative action bill. There's also the Environmental Protection Agency bill that is before the House. That is currently being debated and being worked on. So we expect that at 2 o'clock p.m., the debate on the mid-year budget review will commence. Technically, if you look at the standing of this, it's called comment because the minister did not come by motion. Finance Minister Dr. Mohamed Amin Adam came by way of a statement. And so MPs will comment on this. They would have to refrain from making statements that will provoke debate, and that will all happen at 2 o'clock. We expect that Isaac Adongo from the minority ranking member on the Finance Committee will start the commenting on behalf of the majority. And then we'll probably hear from Patrick Boama, who is the new chair of the Finance Committee, who will also start the commenting or the debate from the side of the majority. And so it's going to go on for 3 days. We expect that today being the first day. It will also happen tomorrow. And then on Monday, on behalf of the leadership of the House, Dr. Kassel Atofos and the minority leader, and Alexander Kwame Martin, the majority leader, who conclude the debate on the media review. Being that it's a statement, we don't expect that a vote will be taken on this. Once the leadership concludes it, then that will be it. The House will move on to other business, and especially since we expect the House to go on break.
Well, how has the presentation been taken by both sides of the House? I mean, it's the first for the Finance Minister, Dr. Mohamed Amin Adam, the last for the Akufo-Addo administration.
It has been received quite well from the majority side. In fact, on the day the statement itself was presented, the NPP MPs really sang songs on the floor of the House to indicate their excitement about the message that the minister put out, insisting that this was a message of hope. This was a budget that really is going to deliver on the mandate of the Akufo-Addo regime. Just 6 months down to an election. They are excited. In fact, some interviews that we've had, these MPs are excited that the finance minister is sticking to the 2024 budget appropriated in 2023, and it's not asking for any new money. It's not asking for any new taxes and all that. They're excited about that. However, the minority really believe that the finance minister has not presented anything. We've heard from the minority leader, Dr. Kassel Atofos, who says the government is bereft of new ideas. They don't believe that the finance ministry have presented anything worth of celebration. And some of them that we've spoken to really believe that the government would have used 5-6 months down to an election to review some taxes, I should say, like e-levy and other things. We are surprised that the minister stuck his guns on all those, but the government really believes that given how the IMF deal is going currently, this is not a time to be reviewing taxes, although the tax handles, some of them are not performing so well. We do believe that if you take them out, that will be a big hole in the budget that the government will struggle to clear. So it's the usual political divide in Parliament. The NDP MPs really believe a good message has been delivered, while the NDC really believe that not much has been said, and it's just a bad message from the government, given that there's 5 months to an election.
Well, we're following keenly when the debate starts. But speak of debates, the Vice President, MPP flag bearer, has been challenging John Mahama, the NDC flag bearer, to a debate. How is that playing out?
Well, yesterday was just a victim on the floor when the majority leader didn't press all the minority MPs to get their leader, John Dramani Mahama, to debate the NDC, to debate Dr. Mahmoud Bawumia. The NDC have made a point clear that they do not believe that Dr. Mahmoud Bawumia is worth the time of the former president. They do believe, and in fact, they've been inviting him to come to Parliament today to come and debate the likes of Isaac Adongo when they start the mid-year budget review. That is the big message they put out yesterday, including a statement at a press conference, inviting the Vice President to come to Parliament and debate their ranking members on finance, the economy committee, as well as the budget committee. Dr. Kassel Atofos, in his own words, John Dramani Mahama is, quote unquote, an experienced driver, and Dr. Mahmoud Bawumia is simply a driver's mate, and the two of them cannot debate.
All right. Well, could it be that the NDC is riding on the projection by First Solutions that it is most likely to win the elections come December? And what has been the response of the Bawumia campaign to this projection by First Solutions?
They have said much. This projection by First is much of a nothing, and that the real Ghanaian people will speak on December 7th and then shock the NDC. They literally talk about it. The spokesperson for the Bawumia campaign back in Parliament as well, the same point has been made, this idea that the Fitch solution prediction hasn't got much to do with the Ghanaian election, and that the Fitch prediction is simply a take-on from the work that has been done by Global Info Analytics. They do not believe that Fitch has done anything, but Fitch, a reputable international organization, They predicted in 2016 that the NDP was going to win. They did. In 2020, they did similar projection, similar to the IEU projection that the NDP would win. It all came to pass. But the New Patriotic Party, both in Parliament and outside of SA, that is why they are down there on the grounds, giving the message out to the people. They expect that it will resonate with the Ghanaian people, and that in the December 7 election, the Ghanaian people will show the NDC that they are the real sovereign, that the NDC do not have a message that resonates properly with the people, for which reason they believe. Fitch has put out their projection, but they believe the 2016 election will actually undo that projection. In fact, some of them have been citing projections in 2016 that put Hillary Clinton way above Donald Trump. But when the election did happen, Trump just did win that election. So that is what they are saying. But Fitch, they have made a projection. There are a lot of research around that saying the NDC will win. But they believe they still stand a chance. That is why they're on the ground doing their campaign.
Yeah, we need to point out that the projection by Fitch Solutions was made based on people's opinions about how the economy was being managed, about the job situation in the country, which are critical issues ahead of the polls in December.
Definitely, big issues. Employment, the economy. It seems to me that the economy is going to be the biggest issue going into the election, given how the city is performing, the relative stability of the economies. The New Patriotic Party is seeking to ride on that to see that things are getting better, for which reason they believe that things might change better by the they believe that inflation would have gone down considerably, the city will be becoming much better, and petroleum prices will also have stabilized by December. They are hoping that if all these come to pass, that Fitch Solutions prediction that the NDC is going to win is not going to come to pass. And that is exactly why they are confident that their message is going to go down well on the ground, and they stand a good chance of breaking the eight.
All right, parliamentary correspondent Kweku Asante, I'm sure we'll check in with you in the course of the day when that debate begins on the media budget review. Thank you so much. Before we go, just a look at what's trending on our website, myjoyonline.com/business. Exchange rate volatilities could cause government to miss end-of-year inflation target. That's according to Dr. Theo Echampong. Also, African countries must not settle for less when negotiating with the IMF. The Afri-Exim Bank president there. myjoyonline.com/business. My name is Darryl Kwao. Thanks for watching The Marketplace. We will be back same time tomorrow.